Hi, I'm Jimmy. In this video, we're looking at a company that Warren Buffett has been buying in spades over the past year or so. So the question is, do we want to buy a piece as well? Now, to come up with that answer, basically what we're going to do is we're going to briefly run through the basics of Occidental's business. By the way, the company's Occidental Petroleum. We're going to look at Occidental's business. We're going to look at some recent events. We're going to run through some of the basic financials. And then we're going to try to come up with a fair value for Occidental stock to see if it's worth for us to jump in and buy it today. Okay, now let's jump over and look at their business segments. So their largest business segment is oil and gas. Another way to put this, many companies call it exploration and production. Basically, exploration is when a company goes out and finds oil or natural gas that's underground. Production is the actual drilling for oil and gas, when they actually pull it out of the ground. That's production. Exploration is finding it. Okay, simple enough. Now let's jump over to their next largest segment, which is their chemical segment. So their chemical segments produces chemicals, as you might guess, chemicals that are used in things like chlorine or PVC pipes. They have chemicals that go into refrigerants. This represents about 18% of revenue. Then their next largest segment, their smallest segment, representing about 9% of revenue, is their midstream segment. Midstream is the moving of gas or oils and moving it and storing it. Basically, anything that either transports or stores it is considered the midstream segment. Okay, so that's the basics of their business. Now we're going to want to jump in and look at some recent events because this one is fairly important. Let's start by rolling back to 2019. So back in 2019, Anadarko there was a proposal to be bought by Chevron. Chevron jumped in and said that they wanted to buy Anadarko. So in about mid-2019, Chevron said that they want to buy Anadarko Petroleum for about $48 billion. Well, that proposal only lasted about a month, a bit short of a month. And shortly after that, as you might have guessed, due to the topic of this video, Occidental jumped in, up the bid from $47.5 billion up to $55 billion. Now, this $55 billion offer was going to consist of both cash and shares for Anadarko shareholders. Now, in order to get the cash that Occidental needed to buy Anadarko, well, they were going to use both new debt that they were issuing and also cash that they already had on hand. Now, when we jump over and look at the long-term debt of Occidental Petroleum, well, you might look at this chart and realize it is super obvious where they bought Anadarko since we see a gigantic jump in debt. Okay, so we just want to remember that this big jump happened because the Anadarko purchase. This is going to become important down the line. But as we might notice since that time period, well, debt has gradually reduced. In fact, coming out of the Anadarko purchase, management explicitly stated their intent to gradually decrease debt since they had such a big jump after the Anadarko purchase, and they've done a fairly good job of doing that. But that has led us into more recent times where they had announced a plan to sell somewhere between $4.5 and $6 billion in assets to try to raise additional cash. The plan is to use that cash to pay down the debt. Now, the key point here is that they plan on selling non-core assets. That's integral to what they're doing. But now, let's imagine a company, we'll call them, Occidental, and they're going down this road. We saw the chart, they're paying off debt, they're doing a good thing, but suddenly they stop and they go in the exact opposite direction. Instead of selling non-core assets, they jump in just recently and announce an acquisition of Crown Rock assets. So more specifically, what they bought is Midland assets, basically assets located in the Midland Basin. Now you might ask, what is the Midland Basin? Well, let's jump over to a map of the Permian Basin. The Midland Basin is a basin within the Permian Basin. This one right in the center, that's the Midland Basin. And the Permian Basin in general, this entire region is located in Texas and goes into New Mexico. This is the best place from a cost perspective to drill in America. The best place, the most affordable place, we're talking sub $50 per barrel to pull oil and gas out of the ground. The best place to drill is the Permian Basin. The Midland Basin is one of the best basins within that area. So they pick up 94,000 net acres from Crown Rock in the Midland Basin. Now, the reason that this is so valuable, the reason that they would be so interested in doing this is that they already have acres and wells in the Midland Basin. By the way, they also have wells over in the Delaware Basin, which is not too far from the Midland Basin. But this is huge because they pick up 94,000 acres in the Midland Basin, and these are amongst the best places in the United States to drill for oil. Now, the reason that this is so important is because most oil and gas companies, they have fixed costs to pull oil and gas out of the ground. So it might cost, let's pretend a company costs, costs $48 on average to pull that oil out of the ground. It costs $48 a barrel. Well, if oil's trading at $70 a barrel or $90 a barrel or $50 a barrel, it costs them the same $48. Generally, based on the location, again, Permian Basin, best place in America to drill, the costs are fairly low. That means that ultimately what Occidental picked up was high margin acreage from the Crown Rock assets, which partially explains why they took such a drastic turn in direction coming off of, hey, we're going to sell assets. We're going to buy assets. Okay, so now we know what assets they're buying. Now let's jump over and summarize the deal. And ultimately, what is this deal costing? So we know that they're buying Midland assets. We already said that. What I don't think I said was that this deal, the assets that they're buying, is expected to add about 170,000 barrels per day. By the way, if you're ever analyzing an oil and gas company and you see BOE/D, a lot of times they'll say, that is barrels of oil equivalent on a daily basis. So let's say a company isn't drilling for oil, they're drilling for natural gas. Natural gas doesn't work in barrels, it works a little differently. So companies generally do the math to make them all kind of a standardized number. So 170,000, it's not just oil, it's barrels of oil equivalent. Could be natural gas, could be natural gas liquids, could be oil, a lot of different things. Just wanted to clear that up. Okay, so this deal, they're getting 170,000 barrels per day, but it's going to cost them about $12 billion. Now, that $12 billion is coming from two different sources. One, they're issuing some shares. They're expected to issue about 30 million shares. So those shares are going to be dilutive to current investors like, let's say, Warren Buffett, perhaps us if we're interested in this. Then they're also going to take on some additional debt. This was the turnaround problem that I was talking about before. They were trying to pay off all their debt, and boom, look at that. They're taking on a little over $10 billion in new debt. Now, that $10 billion is actually coming from two different debt sources. One, they're issuing a bit over $9 billion in new debt to have to pay to get the assets themselves. They got to come up with the cash flow. They got to take on $9 billion plus in new debt. Plus, they are acquiring in the acquisition, they're assuming some debt. A little over $1 billion in new debt is coming over, in a little over $1 billion of debt that was already there is now coming onto their books, which is how they end up with about $10.3 billion in new debt. So now when we jump back to the debt chart, well, now we can see that a pop up from here of about another $10 billion is clearly going to be noticeable. Okay, now one thing I think is important to bring up regarding their debt and their business in general is when they announced the Crown Rock acquisition, they also said that they're going to pause their buyback program. They're going to pause it. They explained that they were pausing it to focus on moving the appropriate amount of resources to the Crown Rock acquisition, which should help the operational efficiency of the business and ultimately free cash flow. So I know that that's out there. And of course, everybody likes buybacks, but I have no issue with them doing that. I think big picture, that's the right move. Funnel those resources to make this acquisition improve the business for the long term, which I think is a very good thing. That being said, with them trying to increase free cash flow, let's jump over and look at the fair value calculation for Occidental stock using discounted free cash flow. By the way, this calculator is over on our website, investorsgrow.com. I will leave a link in the description below for how to get access to that. If you're curious, we do a bunch of live streams over there. All the charts you're seeing are all from that website. Do a bunch of analysis each week. We do 3 different live streams. It's a lot of fun. If you're curious, link in the description below. But basically, using analyst estimates for the next 3 years. Well, we end up with a fair value of about $77 a share. The current price is in the low 60s, gives us a margin of safety of about 17%. But that's not where this stops. Let's jump over and look at the chart for free cash flow. So the first thing I want to point out is that each year you get a different number of analyst estimates. In year one, we get about 12 analysts are giving us that 4.3 billion, then 13, and then it drops down to 9 analysts are projecting the final year. Now, this is real important because we use those 3 numbers to come up with the fair value of $77 per share that we just saw. But the real important part about analyzing a company like Occidental or any oil and gas company is that in order to come up with free cash flow estimates, well, first you got to estimate what revenue is. How do you calculate what revenue is when one of the big revenue generators for a company like Occidental, we saw earlier in the pie chart that most of their money is exploration and production. Most of their revenue is generated from exploration and production. Well, that's important because let's imagine that they're going to pull a certain amount of oil out of the ground each day, each week, each month, each year. They're going to pull a certain amount of oil out of the ground. Well, what are they going to sell that oil for? That's one of the holes of oil and gas companies. One of my biggest issues with oil and gas companies is they're not really in control of what they sell oil for. That is a market price that is set by the global market. Now, in our case, since this company is predominantly in the United States, well, the best oil price metric to use, there's different ways to measure oil. The best one to use is called the West Texas Intermediary, WTI oil. In fact, we could jump over to this chart. This is a chart of WTI oil going back the past year. Since they are drilling oil, pulling oil out of the ground right near here, this is a good benchmark to use. This is a popular one based out of the United States. Well, the real question is, we saw analyst estimates for free cash flow. There has to be an assumption about what oil prices will be. So I went through and tried to find research reports for as many of the companies that are in our database as I could to try to gauge. In a lot of the research reports, they generally will list what their anticipated oil price is. And basically they take, that oil price, in this case, $70, $80, $90 a barrel, whatever they're assuming, and then they multiply that by however many barrels they're pulling out of the ground each day. That's how they come up with estimates. It's fairly straightforward. Well, as we can see here, $70 a barrel is what they're using on average to come up with those free cash flow numbers. Some analysts thought that was way too low. In fact, if you look at this chart over the past year, $70 is probably on the conservative side. On the high end, they were up above $80 a barrel. So what would have happened if instead of using $70 a barrel, we used $80 a barrel for our estimated oil price? How would that affect free cash flow? Well, now if we jump over to a customized free cash flow chart, the switch from $70 oil to $80 oil, that minor $10 assumption moves free cash flow estimates up to about $6 to $7 billion on an annual basis going forward each year. Well, that jump, that $10 jump in oil prices, has a big impact on what the stock would be worth. So when we jump over to the new calculation using these new numbers, well, now we can see the fair value for the company ends up being about $95 per share. Clearly, that's a big difference. So the underlying assumption for what oil prices will be, or what we think the average oil price will be over any given year, is an important one. We're going to come back to that in a minute. So before we jump in and determine whether or not we want to buy Occidental's stock at the current price, do we want to buy what Buffett's buying? Before we get into that, there's actually 2 different data points that I think are important with this stock in particular. First is dividends. So this is a chart of their dividend history going back the past 10 years. And we can see that when COVID happened, there was a big pullback in their stock, in their dividend. So they kind of paused dividends, which is probably a smart move for a while. And then since then, they've been slightly ramping it up ever since then. They're paying a dividend yield of a bit over 1%. So if dividends is important to us, for me in this case, not terribly important. But if it is important to us, dividends there, and I would expect it to gradually increase over the coming years. The next data point that I think is important to look at is insider buying. So this is another chart over on our website. And basically, this shows over the past 12 months, how do buyers stack up compared to sellers? And we can see in this case, there have been significantly more shares bought by insiders than shares sold. Okay, so now let's jump over and look at what this data looks like, but in a chart form. So this is another chart on the website, and basically it tracks the biggest buyers and biggest sellers over the past year. Well, we can see that the sellers are all kind of grouped together, and the buyers, they've kind of spread those out. Most of the buying by insiders happened at the tail end of last year, although recently, June or July, the 8th largest buyer bought some shares then. I'll leave you to guess who you think that is. We'll come back to that in a second. So real quick, let's look at these sellers. Why are there so many sellers grouped together at the same time period? Now, to better understand that, we can actually scroll down on the website and look at this table, which gives us the top 10 sellers according to the number of shares that they sold. Now, the first interesting thing that we might note here is notice many of these happened on the exact same day. In fact, the 8 largest sellers happened on the exact same day. Well, if we click on this little I button for each one, it tells us the details about that particular trade. And we can see here that Vicky Halab sold a little bit over 91,000 shares at $57.62. Vicky Halab, I think is how you pronounce it. Well, she's actually the CEO of Occidental Petroleum. She's been the CEO since 2016. Before that, she was a chief operating officer for a little bit, and she's on the board of directors of Occidental. And interestingly, I actually happened to notice that she's also on the board of directors of Lockheed Martin. Not terribly important to this story, but kind of interesting to note. Now, we can see that she bought her shares, she sold her shares at $57.62. If we were to click through each of them on that date, you will see that all of them, I'm not going to do it, and I don't want to waste your time, but if you were to do it, you would see that all of them sold at the exact same price. Now, this is actually part of a plan called the 10b5-1. It's based on the SEC rules about insider trading. So what many companies do is they set up a plan that if insiders want to sell, they don't pick the price, they don't do anything. There's an algorithm that's put out there that chooses the price, the date that they're going to sell, and all that stuff, and all the insiders do it at the same time in order to stay compliant with insider trading laws. So many times when we jump back and look at the chart, well, many times if you see a lot of these cells grouped together, it's very possible you'll find it in their SEC filings. It's very possible that that is happening because of a 10b5-1 plan, and it's just a clean way to avoid the legal hassle of insider buys and sells. Okay, so that explains the sells. What about these buys here? Let's jump over and look at our table to try to get a little bit of information about who this was. Well, looking at this, it was Buffett across the board. Who was number 8? Are we curious? No, Buffett. All of them, Buffett. The reason the chart was so many more buys than sells, it was Buffett. In fact, if we look at the dates, we can see all year he's been consistently buying over the past year. It's a little more than the past year, but he recently bought in the past couple months. So clearly it's a stock that he continues to be interested in. So when we jump back to the chart, the mystery of who was number 8 here is solved. It was all Buffett. That being said, do we want to buy this stock? And what is the margin of safety that we want? Well, now let's jump back to our discounted cash flow calculation to try to come up with what a reasonable fair value is. We showed 2 examples of the fair value. First one right here assumes a $70 oil price, gives us a fair value of $77 per share. The other fair value calculation assumes an $80 oil price, gives us a $90 fair value. Now, when we jump over and look at the West Texas intermediary chart, the question is, what is the most reasonable number to use? Because I like being conservative, we could go with the 71, but I actually think it makes more sense here, looking at this chart over the past year, and just assume that the average price is going to be somewhere in the middle. We'll call it about $75 per share. So jumping back to the discounted cash flow calculator, well, here, if we were to blend this discounted cash flow calculation with the other discounted cash flow calculation, ultimately, what we would end up with is a fair value right in the middle. That would put our fair value at about $86 per share compared to the $77 per share, which gives our margin of safety of about 26%. Now, don't forget that this fair value calculation assumes that we have an average oil price over the next 3 years, is ultimately what we're assuming. The average oil price is about $75 per barrel. For a barrel of oil, $75. Now, the question is, do we add Occidental? Do I want to add Occidental to my portfolio? And the answer is actually yes. So after my analysis, I generally like to set my margin of safety after I do my analysis. The riskier a company is, the higher the margin of safety. I think that a reasonable margin of safety for this company would be somewhere in the 15 to 20% range. Basically, we want the margin of safety to be above 15 to 20%. In the name of being conservative, 20% right now, it's sitting at 26. So this company looks like a good buy right now. Plus, for anybody who likes Warren Buffett and likes what he's doing, we're in good company considering he's just recently bought this stock. So that kind of adds a little bit of confidence to buying this stock now. But I will say that I plan on buying not a full position. I plan on buying a half position. So I'll be doing a video on my portfolio in the near future. Hopefully Occidental will be in there, but I'm going to buy a half position primarily because, and I'm not going to do a full position, primarily because it's the $75 for a barrel of oil. Oil price is something that is out of Occidental's control. Oil went over $100 a barrel when Russia invaded Ukraine. They had nothing to do with that, but they were beneficiaries of it. If something crazy happened in the other direction and oil prices fell, well, they would be less profitable. And again, they have very little to do with that. Some from a supply-demand standpoint, but overall, because of that, it worries me when a company doesn't have control over their margins. I do think that their portfolio of assets is fantastic. I think that this acquisition of Crown Rock is a fantastic acquisition. I'm more than happy to see the company be temporarily diluted from the issuing share standpoint to improve the free cash flow over the long run. So I'd love to jump in and buy this one. Now, as is my personal rule, when I'm going to buy a stock, I first release this video. Once I release it, I'll wait a few days, then I'll jump in and buy it, assuming I still have my 20% margin of safety, which based on the current price, looks like I should be there. But this will hopefully give you time to do your own research. If you'd like to get access to our website to help you do the research and analyze companies, and you can kind of watch some of the live streams and ask questions, things like that. If you'd like to get access to that, I will leave a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.